where we have two things, two blocks. One, we calculate the income or receipts from customers. And the second block, from that income, we deducted the cash paid to my admin expenses, or in short, the amount paid to the suppliers and employees, which is normally my non-operating expenses. So the formula which we followed for the direct method is, first we find out the amount of sales. From this amount of sale, we have adjusted the opening and closing balance of debtors and bill receivable, and then what are the answers is cash from sale. So this was our first answer. From this, we try to find out what are the other things. So we have adjustment about closing and opening stock. We have adjustment about creditors, and then this is my second block. To find out the cash flow, what I have done is, first my income and second about the payment. I just deducted one from two, and whatever the balance, it is called as a cash flow in direct methods. So we discussed an example where I explain the things and effects. I hope the things are remembered. Is there any doubt about direct method? I guess no doubt. So let's move on to the other method, that is indirect method. In indirect method, the profit before tax and external items are adjusted. What step we follow? The step one, in indirect method, we are considering the cash flow from operating activities and non-operating activities, direct and indirectly. So here, instead of just figuring out two blocks, we have multiple adjustments, and we'll get more clear and exact picture about cash flow. The first thing we are going to do is we have to adjust the change, that is increase or decrease in value of current assets and current liabilities. The second, we have to find out the sale of assets, depreciation, and fictitious or intangible assets which are written off. And then we have to understand the investment or financing cash. So here we are analyzing the flow of money, the purpose of flow in different sectors, in different categories. And by this means, we are going to figure out how much my gain, how much my loss is there. So, like the direct method, where I have ascertained only the certain blocks, in indirect method, I'm going more particulars. I'm more calculating about the flow, about the gains, and I'm asserting the profit or loss made by me. So, what is the major highlight of indirect method? The major highlight is, in direct method, the sale or change in assets or investments is not so counted well, which is counted much more better and effectively in case of indirect method. In direct method, we are ignored the adjustment to the profit and loss account, where the outstanding and prepaid things are not so easily convinced or counted. But these all things are being managed and considered in case of indirect method. In case of indirect method, the cash flow adjustments are much more compared to the direct method. So it is suggested always to follow an direct method if I want the calculation to be an average level or in general. But when I'm interested to dive in deeper and understand the exact cash flow, most of the time indirect method is followed. For your examination and in future also, we normally practice indirect method in place of direct method. Why? Because it's more accurate and more systematic. So the format of indirect method is like this. I'll just wait for few seconds. Please read the format. Then I'll explain it. So let's continue the exploring the indirect method. In indirect method, the number of adjustments are much more compared to the direct method. We have first thing is a net profit before interest, tax, and extraordinary items. So it means we have to first write down the gross profit and then we have to make the adjustment for depreciation, fixed assets, provision for emergencies, provision for retirement benefits, the difference between sale of investment or assets, interest received, and operating profit before working capital changes. I'll just reduce the zoom in and so forth and so on. So the format, if you can just see, it is a larger way. First, I'll find out these details. Then from that, I will be using the other statement, that is statement showing changes in current assets and current liabilities. Then I will do the adjustment for tax paid, cash flow, extraordinary item, and then I have net cash flow from operating activities. Now, as per the format is concerned, I have shown this in combined, but actually when we are solving the numericals, we normally make three statements. The first statement we make is a statement of cash flow. Second statement showing the changes in working capital. And third, a statement where we are calculating the cash, we are calculating the alternates or adjusted profit and loss accounts. So this pattern of cash flow is a complicated where three different statements are a part of my cash flow. Now, before we in formats, let's understand the some very essential concepts about indirect method. The direct method is a very direct and limited approach where it will cover the limited things about the cash flow, whereas in indirect method, the things are more highlighted and each and every aspect responsible for cash flow is covered. So the first thing we'll talk about non-operating expenses and reserves. In case of non-cash items which appeared in an account but do not have impact on cash balance, So these are certain amounts, certain expenses, which has no relation towards my cash balance. For example, my capital reserve from 10,000 becomes 15,000. But when my capital reserve increase or decrease, it is not going to change anything towards my cash balance. Because even though cash balance changes, the reserve is not going to change. Or in any this way, there is no relation between the capital reserve and cash directly in direct methods. The second thing, these all items are shown in income statement. They are not directly affecting cash flow, but they are affecting indirectly. For example, when my general reserve increases, the profit which is kept aside, it is there. The non-operating expenses, when they change, they will create a repercussion over my liability. The liability create a repercussion of my fixed assets. Fixed asset create an impact over my expenditure, and this expenditure indirectly makes an impact over my cash balance. So in indirect method, even though items are not so directly making impact, they are again taken in cognizance. So when I have reserve and surplus, even it is not directly affecting my cash balance, but it is going to make impact because anything paid in advance or anything outstanding, it is going to make an effect to my cash balance. And hence, we need to adjust the non-cash items also. Then there's a question that if I'm adjusting the non-cash items, what is the difference between cash flow and fund flow? Now, most of the cash flow is of revenue nature. It ignores the capital expenditures and it is more accounted towards a particular year and up to the deferred revenue expenditures. It simply ignores if the items are more than 3 years and 5 years. But if a salary is outstanding, wages outstanding, these outstanding amounts I'm going to pay. So why they are outstanding? Because I'm not paying. So the future expenses, the adjustments, even though currently they are not impacting over the cash outflow, they are taken into considerations while deciding the cash flow in indirect method. The second most, the first one is depreciation. Depreciation is an amount we deduct from the value of an asset for wear and tear. We deduct this amount for using that asset or keeping some funds separately for replacement of that fixed asset. So when I depreciate, actually it's a non-cash expenses because I'm not paying anybody. I'm not making an effect where the money is going in or out. When I charge any depreciation, it is not going to make an impact over the available funds in my organization. But while computing cash flow, they are added back to net profit. The simple reason this is not a expenses. This is a mere adjustment. I'm adjusting from the value and I'm keeping some amount as reserve. So in cash flow, the depreciation is added back in net profit. Please go to the slide. I'll wait for 1 minute. Any doubts? Let's move on. So we are clear the first thing that is depreciation we need to add back. Now what we do about goodwill, patents and copyrights. In case the goodwill, patents and copyright, they are not actually affecting the cash flow. So if I'm creating any of these assets out of my current cash flow, then they are again added to the value of net profit. So if I'm creating goodwill, if I'm creating any reserves, they should be added back to the net profit. If any accumulated expenses like accumulated loss or capital expenditures I want to set off, then they will not directly affect the cash flow. It's a mere adjustment out of the profits. But this adjustment will not give me the correct operating profit, and hence, to get a correct operating profit, these expenses are again added back. When I have something profit or sale on a fixed asset, then if I make a profit, it will increase the gain. If I make a loss, then I will lose the gain. But in cash flow, if the loss is there and it is deducted from profits, I need to add back. If profit is recorded additionally, I need to add back. So if you take the non-cash items, most of the time you'll find that we are correcting our profit figures and we are adding it so that we can use for our better convertible way. I will explain this when I illustrate one of the first numerical. Let's move on to the further. In case the fixed asset is sold during the year and we have calculated depreciation, then the depreciation is again adjusted and added in the net profit. Second, amount of profit or loss on the sale of fixed asset is adjusted according to effect. For example, if the profit is there and I mention on credit side of P&L account, that will increase my net profit. But actually, I am not gaining anything. So if I increase the net profit by adding the profit on sale of fixed asset, then in such case, the profit is deducted from net profits to get actual operating cash flows. In reverse, suppose I have loss on sale of assets, then while showing the loss, it will reduce my amount of profits. So whatever the gain or loss on sale of fixed asset, they need to adjust it separately before claiming the income. The amount which I received by sale of fixed asset, they are considered as cash flow from investment activities. And if I purchase some fixed asset, it is recognized as cash flow from investment activity only, but instead of adding, I'm deducting. So let me explain this by way of uh, format. Now let's understand the first thing. This is a profit and loss account. Normally, I mention my depreciation, I mention my dividend, I mention my profits, I mention my loss, I mention some other income in profit and loss account. So this is a regular practice to record the transactions. Now, as per the indirect method, the depreciation is not permitted. So I return depreciation on debit side. I need to switch on credit side to make its effect zero. I paid any dividend, it is expenses. Again, I'm switching the side to make effect zero. If I received any profit from sale of assets, this is unnecessary things, and again the same treatment is done. Whereas if I'm suffering a loss, this loss is due to my claimed the amount which I'm being concerned, I'm being charged due to change in assets. So here the loss again will be shifted to a debit side. Sorry, the income which I received is shifted to debit side and so forth and so on. So what are the effects I earlier given? The debit effects, they are shifted to credit, and what are the credit effects, they are shifted to debit. And that's why I required to make profit and loss adjustment account as part of this indirect method. If I do not make a statement called adjusted profit and loss account, then the figures, the amounts which are shown are become irrelevant. These figures are not so useful to quote the exact cash flow, and hence I need to adjust the non-cash items. Similar to this, the general reserves, sinking for provision for doubtful debts, their purchase or sale of fixed asset, the gain or loss on purchase or sale of fixed asset, or provision for taxation, provision for dividend. These all non-cash items are being adjusted in profit and loss account to ascertain the exact gain or income which I have achieved. So, in short, to get a correct profit which can be recognized as operating profit, I need to give the reverse effect. of non-cash items which are causing the operating profit balance as negative. I'll leave it for 1 minute. Please go through this slide. If in doubt, I can explain. So let's continue further. Now let's understand the treatment of some financial special items. The first thing, financial enterprise. The interest paid or interest received should be treated as cash flow because here the money is actually coming in and going out. Second, the interest in arrears is not recorded. Only the amount of interest received is considered. For example, I supposed to get interest for the 12 months, but I just get an interest of 10 months and 2 months interest receiving is outstanding. So I'm short of 2 months interest. So in that case, only the 10 months will be shown in cash flow and the 2 months arrears, they are not part of the cash flow. So first thing, interest received or paid is a part of cash flow. But the outstanding or prepaid, in that case, prepaid can be a part of cash flow, but outstanding is not part of cash flow. Now the question is why prepaid is part but not outstanding? Because in case of prepaid, we have already paid these expenses. We have already made the payments. So the cash is gone. And that's why prepaid interest is allowed to be part of cash flow, but outstanding is not yet paid. So they are not allowed in indirect method as a part of cash flow. Then let's talk about treatment of dividend. First, basically, dividend is that amount which is paid to the shareholders. There are three dividends. One, interim dividend. Second, final dividend. And third, advance dividend. Normally, advance dividend is no more concept is there, but technically it is measured. The interim dividend is dividend which is declared in middle of the year or before completing the 12 months period. The final dividend is that dividend which is actually paid and approved in AGM of that particular organization. Whereas advance dividend is dividend which is paid before approval of board of directors. So dividend is an return which is paid to the equity holders, preferred shares for their contribution or for their investment in organization. So if the dividend is received, it means I'm receiving the money. It is showed as cash flow. If dividend is paid, it is shown as again a cash flow. And similar to the interest, arrears or outstanding dividend is not shown. So in treatment of dividend, again, treatment of interest, the reactions are same. Whatever we receive, it's mentioned. Whatever we pay, it's mentioned. But if the payment is outstanding, we never mention in cash flow. I'll wait for a minute. Please read this slide. So let's move on to the other topic. Treatment of tax. The taxes are separately disclosed. If I am paying some tax, they are again treated as cash flow activity. But if I'm creating some provision for tax, then it is not created as a cash flow. It is considered as hidden adjustment, and the provision is added back to the profits. So, in case of treatment of tax, if paid, outflow. If I receive the tax refund, it's an inflow. But if provision is made, then the provision for tax is adjusted back to the net profit. Please go through the slide. In about the items, if any doubt, you can just post in chat box. I'll wait for 1 minute. Any doubts? So simple formula: received or paid, record in cash flow. Outstanding, we cannot record it. And in case of tax, if the provision is made, then that provision is not considered as expenses, and we need to add back the amount of provision towards net profit. I just skip this part because we already discussed. So here's the illustration to show you. Following are the abstracts of balance sheet of ABC Limited. I have profit and loss account, opening balance 60,000 and closing balance as 1 lakh. The provision for tax was earlier 10,000 and the ending it is 15,000. So this indicates the current year have increased the provision for tax by 5,000. My profits are increased by 40,000. So as per law, the profit made during the year is 40,000. But since the provision for tax is added, because anything provision I made is just a mere adjustment, it is a non-cash items. So I should always remember the effect that in case of any provision, I need to adjust the provision in the tax. So my income or my profit during the year is 40,000 and I'm adding the 15,000 provision I made in current financial year. And that will give me an idea that the net profit before tax is 55,000. Please go. So this kind of effects we are giving for our tax treatment. These same effects we are giving for our interest. We need to adjust the profit and loss account. Now here I shown in a vertical statement, but we need this adjustment in a profit and loss account. And that's why while preparing the cash flow statement, I'm also preparing a statement called adjusted profit and loss account. I hope it is clear. Anybody doubt in this working? I guess no doubt. So let's move on. So we have provision for tax account, and this is a working that cash that is tax paid is 10,000 and balance is 15,000. So we have current year provisions as 15,000 for tax payment. Now take the second example. Following are the extracts of balance sheet where the profit and loss account was 60,000 and now it is 1 lakh. What it means? It simply indicates my this year profit is 40,000. The provision for tax is 15,000. As I said earlier, the provision is not allowed, so it is added back in the profits. So I have 15,000. Then during the tax year, the tax paid was 12,000. So how the related item appears. Now the tax paid is an expenses, so minus 12,000. So my profits will be 43,000. Let me show you the working. The profit in a year was 40,000. Provision for tax was 17,000. So here my net profit becomes 57,000, the first effect. And the second effect is income tax paid. So whatever the income tax I paid, that is 12,000, is my expenses. And these expenses I need to deduct before calculating the final net cash from operating activities. And in this case, I deduct the 12,000 and it becomes 45,000. So let me show it again. My profit, that is 1 lakhs minus 60,000. It is 40,000. I have 15,000 as provision for tax. So my profit becomes 40 plus 10, sorry, 50, 55,000. Less, I need to deduct 12,000, which I made an expenditure. So my final answer will be 55,000 minus 12,000, 33,000. Here there is a typing mistakes about provisions. It is shown 70, so I corrected manually. Let's find out and numerical the Following is extract from the balance sheet of ABC Limited. Profit and loss account was 60,000 and 1 lakh. Provision for tax is 10,000 and 15,000. The provision for tax made during the year 11-12 was 14,000. So now I require to find out the profits. So we follow the same method. So we have two options. We can do it year wise and then make the cumulative, or we can make it separately. So for first working, we'll make it separate. So here, the provision for tax is not allowed. So I'm sorry. So in this case, my profit will be 70,000. Here it will be 85,000. And if I calculate, my profit before tax will be 15,000. So this is the simple method if I do it year wise and compare it. But as per the indirect tax method, I first required to find out the difference between 2 years profit and loss account, and it is amounting 40,000. Now, here the first thing I'm making adjustment is a 14,000, because this 14,000 and this 15,000 will become 29,000, and I need to adjust in 40,000. So my answer will be 40,000 plus 15,000 and plus 12,000. So these are the provisions. It will total become 57,000, and from this 57,000, the income tax paid will be deducted, and then I will have the final value. So if any provisions are made about tax, interest, or dividend, these provisions are added back. And in reverse, if the things are paid, it can be in advance or it can be in short. These are considered and shown as expenditures. Now, let's talk about cash flow and its impact from various activities which are fall into category of investment. Now, earlier we had done the non-cash items. When I say investment activities, I hope you have read the slide. When I say investment activities, I am morely focusing now The activities are related to money. The amount which I pay for investment is considered as outflow, and amount which I received from investment is considered as inflow. I am not here interested to categorize as regular cash flow and occasional. For so in this case, income or expenditure which I received from investment, they are considered as cash flow. If I receive the money by sale of fixed asset, it's inflow. If I paid for purchasing, it's outflow. If I sell, it's inflow. If I buy, it's outflow. If I give any advances or if I give any commission, then they are again being considered under cash flow. So the tangible asset or intangible asset, it can be of any nature. In both the scenarios, if funds are received by way of sale, I have to record. If funds are applied, that means if I paid the money for acquiring these assets, then I need to write as cash flow. Any investment activity or any kind of investment where money is received, I need to record. So for investment activities, we follow in format the sale of assets less purchase of assets, and we do the adjustment of all this. For example, if I have sale of assets, it is considered as my income. If I purchase an asset, it is called as outflow. Long-term investment, it is outflow. Sale of long-term investment, it is my inflow. Interest received, inflow. Dividend received, inflow. And then I will adjust it. So profit received in cash, income received in cash, or profit paid in cash, or amount paid for purchase of investment activities. All these things are considered in cash flow adjustments. Let's give an example. From the following, I need to prepare the cash flow statement. Machinery as on 1st April 2011 is 80,000. Machinery on 31st March 2012 is 90,000. What it indicates? The machinery has increased by 10,000. So my machinery has increased by 10,000. The accumulated depreciation on the year starting was 22,500 and at the end it is 37,500. It means I have charged the depreciation of 15,000. So The depreciation in a year is 15,000. The change in machinery is hardly 10,000. During the year, machinery costing 37,500 was accumulated depreciation and sold it for 18,200. Now here we got three things in a cash flow. One, change in value of machinery. Second, the depreciation. And third, sale of machinery. Now, what is the plus or minus thing about machinery? These things are recorded as a part of cash flow. The charging of depreciation additionally in this year is not permitted. This depreciation we need to add back in net profit. Third, they have given the adjustment where the machinery, which was costing rupees 37,500, having 21,000 depreciation. It means if I adjust 37,500 minus 21, the cost of machinery was 16,500. So the machine of 16,500 is sold at 18,200. So again, I'm having profits, and this income is shown in cash flow. So just read the numerical because I'm explaining virtually. I cannot show the both slide parallel. So we got three things. One, change in machinery. Second, depreciation. And third, sale of machinery, which is costing 37,500, having depreciation 21,000, and we have sold it for 18,200. So indirectly, we has a gain of 1,700 rupees. So you have noted the numerical. Let's find out the solution. See, the sale of machinery we are calculating, it is 18,200. Who purchased for 47,500. So we have machinery account opening balance. Let me just, the machinery account has depreciation opening balance 22 and closing is 37. So opening balance of depreciation 20,500 and closing balance was 37,500. I have accumulated depreciation on the machinery sold was 21,000. So I returned 21,000, and then I'll find out the depreciation which is provided during the year, and it is 36,500. So this is an working note. So when in examination you're solving the numericals of cash flow, it is suggested that whatever the assets are there, open the accounts because this will indicate and explain the effect or the change. Second, we open the machinery account. The opening balance was 80,000. Let me just show you. The opening balance was 80,000. Closing balance was 90,000. And we charge the depreciation 37,500. So let's see the effect in machinery. We are opening balance 80,000. Closing balance was 90,000. And machinery was sold at 37,500. So the difference is adjusted as purchase of machinery. Because in machinery account, other than anything, the price of machinery cannot be increased. Then we purposefully make the machinery sold account so that we can calculate the profit or sale. The opening cost of that machinery is 37,500. We sold this machinery for 18,200 and the depreciation was 21,000. So total become 39,000. So my gain is 1,700. So as a teacher, because of experience, I quoted this gain without calculation of working notes. But about a cash flow, we need to ascertain and understand the cash flow because there are hidden adjustment about purchase of machinery, hidden adjustment about depreciation during the year. Because even it is not mentioned here, I need to find out these two things. And after this, I can talk about my cash flow from that particular year. So I got a depreciation, I got purchase, I got a profit. So what are the profits? It mentioned deducted. If depreciation is charged, it deduction should be done. If the machinery is purchased, like in this case, we find 47,500 rupees machinery is purchased, then this machinery we need to deduct as outflow of cash. And after adjusting all this, we have to calculate the exact cash flow. Now, further we have the financing activity, then more effects. So today we discuss about the different effects on cash flow and how the things are managed. So it's a time for another session. If any doubt, please note down it. We will discuss in next session. In the evening, you got at 6 p.m. the session for financial reporting, then strategic management at 7 p.m. and at 8 p.m. you got a lecture on international finance. So attend all these lectures. Thank you. Wish you a wonderful day ahead.